And we're recording. Carmelo,
Hey, Alex.
how's it going? September 17th, the first overnight rate cut by the Bank of Canada in 4 meetings? How long did they hold steady?
The last rate drop was, I believe, in March. And thanks for the spoiler alert. We haven't even gone through it in our presentation.
Well, I mean, it's all over the news or whatever.
Yes.
I don't know if it's not, but usually CP24 and whatever, they're all covering this like it's such a big deal. But yeah, let's get into it.
So again, thanks for everyone for joining today. We're talking about the Bank Canada interest rate announcement. Short introduction. My name is Carmelo Boutis. I'm a mortgage agent at yourmortgageyourway.ca. I don't post that much on Instagram, but you can find me there. I can message me. I have people message me there, and you can always email me at carmelomortgage@gmail.com.
Yeah, thanks. My name is Alex Vanieski, Toronto realtor with Remax Condos Plus. There's a QR code there that you can scan. That'll take you to my link tree, and you can get all my links and all my socials there. We have more people coming. Yeah, David, welcome. Carmelo, continue, please. The floor is yours. Start it here.
So something happened with the slide. All right, so there's a slide. So again, no surprise today, the Bank of Canada lowered their rates by 0.25%, which was kind of expected, right? The last meeting that was it from July, there was a big pause with regards to there was 2 reports, and we're kind of going to go into that, but they finally did it, Alex. They lowered it again.
Right. So this is the first in how many meetings? I'm sorry, because you clipped a little bit there. At least on my end, you did.
This is the first since, I believe, March.
First rate reduction since March. They've been holding steady, but before March, they were reducing, like, I think, what was it, like 6 consecutive meetings?
Yeah.
Yeah. We'll see that in your chart there.
So, yeah. So the first thing is they cut today. What are the key factors for today's rate cut? Weakening economy, right? The Canada GDP declined by about 1.5% in the second quarter, largely due to the U.S. tariffs and trade uncertainty, right? And Alex, what else is happening? The labor market, the job market is getting weaker, right? In August, the job loss showed 65,500 jobs were lost, and it pushed unemployment over 7.1%.
In Toronto, the official unemployment rate number is 8.9%.
Yeah, it's higher.
It's high. Yeah.
Yeah. So, and also, the inflation risk, it's come down from the levels in 2022, 2023, right? But it rose a little bit in August. The core measure still above their 2% rate at 2.5%. But again, they see easing in it, right? The Canada, if our federal government removed tariffs with the United States. So, and a tariff is when we import something from the United States, we are paying the tariffs. The Canadians are paying the tariff when we tariff another country, right? So removing that should relieve some inflation pressures, Alex. Right, so the Bank of Canada felt like, hey, the economy clearly now is slowing down. They've always said if there's reason for them to act, they will, and they did.
Mm-hmm.
So that was really good.
I don't want to get into the political side of it, but that's
I much as I want to talk about
politics, but that just makes me think there about those points make me think.
I'd rather focus on the rates.
Yeah, let's talk about the rates. There we go. Charts. There we go.
This is something that I kind of like to show, and it's weird how this chart is made, Alex. On the left-hand side shows the rate for the Bank Canada overnight lending rate based on that blue line. Okay. Then the gray line is the 5-year bond yield. So we could see there have been rate cuts, the last one in March. And since then, there was a good pause, right, which was needed. Like, they lowered rates, I think it was like 7 consecutive meetings. So they, after the lower rates, they do need to pause to see what the outcome is. And there was tons of uncertainty, as that's when the trade war was beginning with the United States. Ironically, you could see in the gray line, like since March, yields have went up. And the one thing to put in perspective, I like to always mention, the Bank of Canada, when they change their rates, it impacts anybody with a variable rate loan, mortgage, line of credit, so on and so forth, right? It does not impact fixed rate mortgages. Fixed rate mortgages are based on bond yields, and the bond yield is like the 5-year bond yield impacts the 5-year fixed rate, 3-year fixed rate, 3-year bond yield, and the interest rate that's most commonly taken for a mortgage loan is a 5-year fixed rate. So that's why we're looking at 5-year bond yield.
So I'm looking at this chart, right? So is there what caused the like the 5%, sorry, the 5-year bond yields to go up like into, it looked like mid-July and then start to come down? Like, what was it, political like influenced, or like was it tariff related, or what was that?
Inflation risk.
Inflation risk, not actual inflation numbers, right?
Inflation risk, because there's tariffs and trade wars and uncertainty, and there's still we still think there may be these tariffs will increase prices.
Right, but the yields have come down.
Yeah, but since then, now again, ironically, since July,
Mhm.
right? Since July, there was a lot of anticipation of this, inflation still creeping up, and all of a sudden, weak job numbers 2 months in a row, a horrible second quarter GDP report. Well, then the yields came down in anticipation of today the bank can lowering rates. So I find that, again, like I find bond yields could sometimes be forward looking and anticipate, but they don't always get it right, which is quite interesting. The next thing is, Alex, again, like inflation. Inflation, it seemed like we kind of got things under control. We saw like, in February went quite high, but it's come down, and we're under that 2% level. It doesn't mean we're going to stay here, but the bank kind of feel like, okay, inflation is somewhat under control. We've looked at over the past year, the economy is weakening. Let's try to do a little something to help. The one thing during the press conference is they've recognized, and they said this time and time again, they cannot support the economy for a trade war. That's the federal government, federal spending is what is gonna impact that. If there's a trade war, they can't bail out the economy in Canada.
It's interesting. It seems like they're, well, by reducing the rate, like, are they not kind of just switching position? Because look, the inflation numbers are down.
Well, again, they want to, they know the economy is slowing down.
And they said
know
this was the only factor that they were going to be using. I'm just interested in that. Sorry.
Repeat that.
I thought that inflation numbers, like staying below, a certain rate, that was what influenced their decision regarding the overnight rate. And I thought that this was like the primary driving factor for that.
So the Bank of Canada, their mandate, their goal, their only thing they have to focus on, and that's their full job, is having inflation under control.
Yeah.
That's the main job.
Seems like it is.
If the economy cools too much, Alex, people lose their jobs, prices could come down, right? So they don't want the economy to get too weak either.
Mm-hmm.
Unemployment's going up. With unemployment going up, I think when it comes to especially real estate, this is the biggest driver. You can see since the beginning of the year, unemployment at 6.5 was still quite high, but you see the chart. It's the trend. It's more the trend, Alex. The trend is going up. People are losing their jobs, so we're immigrating more people, and not hiring enough, right? So this is, when it comes to real estate, as much as we all want interest rates to come down, and interest rates have an impact with the cost of the borrowing. If people don't have jobs, Alex, it doesn't matter what interest rates are. You can't afford to pay anything.
I wonder what the Toronto job numbers were back in early 2025. I know we don't have that data now, but just compared to this, it's.
I can't find a good. Again, I get a lot of my stuff from Stats Canada. I can't find something specific or charts when it comes to Ontario. I do know the Ontario unemployment rate is at least 1, if not 2% higher than the country. And again, especially in Ontario, there's a lot of regions like southwestern Ontario with the manufacturing the cars. they've been hit a lot harder than, say, other parts. But to the Toronto real estate market, well, you could talk about that afterwards. It's jobs, jobs, jobs. If people aren't working, if people are afraid of losing their jobs, they're not going to buy that bigger home or go into the market to buy their first home. Or if they're investors and they see a cash flow property, they won't buy that property because if they're worried about losing your job, Alex, nobody's going to buy anything. And unemployment going up is definitely a bad thing. Again, another reason why, the bank can't lower the rates. Economy shrunk, right? We're holding good for the first part of the year, but we all knew there was a lot of front running when it comes to these tariffs and trade. And before April 1st, the United States were buying a whole boatload of our stuff. And it held in until it just dropped, right?
Mm-hmm.
So we still have a lot of high tariffs on, in certain sectors. But this, we're not in an official recession. Usually the official recession happens after 2 quarters of negative growth. But in my opinion, we've been in a recession for a long time.
Yeah.
Things have not been good, even though statistically, the data doesn't show that.
I mean, yeah, I don't know. I don't know. I agree with you that we have been in a recession. Those job numbers, I'm just still kind of thinking about that. But yeah, let's continue. I'll talk about the state of the real estate market later.
Yeah,
that's what I'm seeing. Yeah.
So this is your chart, right?
Oh, yeah. So annual change in average real estate condo selling price. So like real estate market has been, especially in the GTA, kind of like a tale of 3 markets, right? Like condo and freehold, but then like 2 specific different segments in condo. So basically, based on this, you can see kind of where the prices are. The prices are down. Resale condo prices. I'm seeing condos selling at 2018, 2017, even sometimes rates. Numbers, like it's pretty regular. Like the dollar per square foot is coming down further and further. Like I've seen clients buy as low as in the mid $700s, $700 per square foot at like in Midtown Toronto, for example. So, I mean, prices are coming down. I mean, there's still kind of like certain segments of the condo market that are holding, but overall, and I feel like these numbers are also kind of skewed because they roll in like everything into this, including like the small 400 square foot, investor focused condos that an end user can't live in.
And how about detached homes? How are the detached doing?
Detached is like just freehold as a whole, or detached?
A freehold, let's call it, like the semi-detached, the detached, well, like freehold.
Yeah, freehold. I mean, I see pretty healthy transactions, like up to like maybe the $2 million range, and then like anything that's over that is struggling. Stuff that's over $3 million is struggling a lot as well. But like for anybody who's been looking to get into a freehold property, like I've seen freehold townhomes in York region selling in the mid 900s, which is a number that we didn't see in that area since basically like 2021, 2020, before the numbers spiked sharply in 2022. So like, I think there's great opportunities, but like you said, like if people don't have jobs, they can't buy homes. But it seems like there's enough people in the GTA that are shopping. Like I'm seeing multiple offers on freehold properties, seeing multiple offers on condo properties too. Like if it's an exceptional unit, like let's say it has high ceilings, good views, good building, and the seller has, an aggressive price point. I think that's the most important thing here is like pricing for today's market. It's inventory is still moving, but like the small condos, everybody's kind of staying away from the investor focus stuff.
Yeah, no, I totally understand. It's still 2 tapes, right? Like they're both different markets and different stats, right? So,
yeah.
What they lower the rates today, Alex. What do we expect moving forward? Well, Arnie, has a new. They're coming with a federal budget, I believe, November 4th. We need good fiscal stimulus. I'm pretty confident our deficits are going to exceed by a large margin the Trudeau deficits, which is what it is. But this is the time where we kind of do need to be in deficit. I'm okay with deficit in bad times, not in good times, right? So, interesting to see. Like again, they came up with this. They have new committees, new members. They came up with a new department, the Ministry of for large projects. I don't remember the exact name for it. Apologize for that. But again, they already announced like 5 projects that are in focus, and a bunch of them have actually already started. But they're making sure they're going to be fast tracked, and they're thinking nationally. These projects are from the West Coast to the East Coast, which is good. Like Canada needs to be more independent and not as dependent with the United States when it comes to trade. So
I'm sure we're going to come out stronger out of all of this. So there's no doubt there.
I totally agree. Right now, I saved this was from the last webinar we did, Alex, and I saved this because it was a forecast, the Bank Canada policy rate. And ironically, you could see how World Bank and Scotiabank thought by the end of the year the rates would be at 2.75, and they clearly got it wrong. As we're at 2.5 today. However, from July, TD, CIBC, and BMO thought the rates are going to end this year at 2.25, and it looks like they may be right. The one thing I like with this is like we have some really smart people at all the big 5 banks, and it goes to show even the professionals don't know what's going to happen. So if you're looking for interest rates, you want to know more information about it. You could talk to your mechanic, you could talk to a bus driver or a doctor or a friend that's an electrician or a trade or what teachers. Everyone's got an opinion, which is fair, but nobody really knows what's happening, especially the professionals. So when you get in a mortgage, doing anything with real estate, make the decision based on what's best for you, not based on what your friend said, your neighbor did, or anybody else. Even myself, I do my best to make sure I get I help my customers get the mortgage product that suits their needs. Yeah, renewal. You're thinking of selling the next year. You shouldn't be locking in a 5-year fix, right?
Yep, I understand.
So that's
okay.
The last chart, Alex, again, like when it comes to real estate, I thought I like this one with regard to it really shows, because right now there's a lot of media talking about how bad real estate is, and it's like, if you want to explain this, it's perfect. Yeah,
I mean, like I think one of the key things is just we're kind of get a little bit short-sighted, right? So it's real estate. I think that a lot of people got a wake-up call, especially like in the last 2 years. So, as far as like sustainability pricing, we saw a huge spike during the pandemic in 2022. It seems like we're kind of like in a part of the market that's evening out. But I guess like the point of the slide is just like if you look at the market as a something in chunks of years, like you look at it at 5 or 10 years, you can see that in most instances, in 10 years, like their prices have gone up. We used to say in 5 years prices have gone up until 2022, and now you look at this thing and it's just like, I guess where were we 5 years ago in 2020, 2021? Like it seems like we've come up a little bit from that, but not really sure when prices will recover back to 2022 numbers.
Yeah, I'm a believer, Alex. Real estate is a long-term investment, minimum 10 years. From every peak, 10 years later, look forward, it's always gone higher, right? And if you kind of like it should, like you see in 2017, we had a bubble back then, and the pattern's kind of the same. Like we went through a few years of just like when it came down, just kind of stay stagnant until it blew up again, right? So we're having like 2 years of kind of like consolidation where flushing out those bad and those speculative investors, right? It's unfortunate that the amount of money lost this time compared to last time is much larger.
Yeah,
it's healthy to kind of, it makes the market be healthy, and I think with the lack of new construction that's happening in all projects, I think we will see another spike in the next few years. When it will begin, I don't know, but history does repeat itself, especially real estate and Toronto.
Yeah, I mean, I know that there's some people saying that we're going to have a major shortage in 2028. I'm not really sure what's going to happen to all these small condos and what segment of the market is going to absorb them, how long it's going to take for them to be absorbed, at what price point are they going to be absorbed. So You know, I know that some buildings, like if they've pivoted to long-term rentals, some projects have been canceled. You know, as far as pre-construction, we're seeing more long-term rental inventory coming out as well. It's good because for, you know, almost 20 years, the provincial government and I guess the municipal government were just like kind of hands off as far as building any long-term rentals, any new projects. It was all condos and like, let's build these properties and let the investors be the landlords. But now it's, you know, something they're shifting to a more sustainable model. I know like in Toronto, the types of condos are going to be being built as well. Like they're shifting to more of a mid-rise model as opposed to all these high rises or super high rises. It's going to be like stuff that's going to be about 12, 15 stories, more sustainable living, larger units, bigger floor plans, more end user specific. You're going to see a lot of stuff like that, especially on Yonge between Lawrence and York Mills and Lawrence and Eglinton. I think they're going to be doing more stuff there.
That's great. Like in like the purpose-built condos, we definitely need a lot more of that because a lot of the apartment buildings and are really, really, really old. There's all the old ones. You know, they're just a purpose-built rental and they're old. I remember them.
No central air, no ensuite laundry. Even though that used to be completely normal, you know, like I don't know. It's like now it's like people don't want to go to the laundry room anymore and they have to have central air. I don't know how we used to live in the 80s and 90s, to be honest.
So let's kind of end this off. Let's kind of get some feedback and answer some questions for anyone that's here.